Yes, good afternoon. Good afternoon, everyone. So, today we'll be discussing on the operative paper, personal financial planning. So, under this paper, in this session, I'll be discussing on the unit 6th, 7th, and the 8th, which constitute the sixth unit is about retirement planning and its benefit. Seventh one is all about the tax benefits, and also the eighth unit deals with the health financing. Your paper is for the maximum marks of 50, and in the examination you have to write only for the 40 marks for that. The duration of your examination will be for 1.5 hours. So let us begin with the concept of retirement planning and its benefits. Hope this slide is visible to all of you. So under the retirement planning and benefit, so you will be understanding about the introduction, the meaning and definitions of retirement planning, the benefits of retirement, then the steps which are involved in making a good retirement planning, and also the various concepts like EPF, PPF, superannuation, gratuity, and annuity plans, and even you will be learning about the National Pension Scheme. Let us begin with the retirement concepts. Well, the objective of this unit is to familiarize the need and benefit of retirement planning. So it also helps you to be able to understand the factors which influence to prepare a retirement planning, the various stages it is going to take place, and also the different concepts of like a provident fund, EPF, all those things. To begin with, the introduction part, we always say that to plan for 20 years of retirement, start accumulating funds no later than 20 years before the retirement begins. So, it is a kind of 2020 rule. What we mean to say is, if your age of retirement or you're planning to get retirement from your work at the age of 60, at least at the age of 40, you have to plan for a proper retirement. So that is what we mean to say that. So it is one of the most important events of everyone's life, and most of us, definitely, we all of us will experience these things. The concept of retirement is to make the comfortable life after the retirement of an individual from his work. So that is the concept here. So by realizing the comfortable state of retirement and the need for planning the finances is much necessary, because here retirement planning usually requires a combination of financial and personal plannings, so which determines one's satisfaction during their retirement life. So we can say that the financial plans generally help us in budgeting the income and expenses based on our personal plan, and even it helps us to fulfill the lifestyle needs and preferences. So by estimating our retirement amount now, if we try to plan from now itself, we need not have to suffer in the future, but we can get the retirement benefits in a proper manner. So retirement planning usually refers to provision of finances for retirement. So it means generally means that setting aside of money or other assets to get a steady income at this stage of retirement. So the goal of retirement planning is to achieve financial independence, so that there is no need for anyone to be dependent on others. Instead, they can be employed in optional rather than necessity. So retirement planning usually is an inherent part of financial planning. It is usually multidimensional. So it is the process of determining retirement income goals and actions and decisions which are necessary to achieve the goals. Usually, the retirement planning includes the identifying the sources of our income, then sizing up of the expenses, implementing in the saving schemes, and also managing the assets and the risk associated. In simple sense, it is a financial planning one does to prepare prepare for the life after paid work ends. So not just financially, but also in all aspects of our life. It includes the lifestyle choices and how we spend our retirement life, where to live, how to live after completing or after completely quitting our work, etc. And even it helps us to understand the effect of inflation after time of our retirement or after the time of our retirement. So there are various benefits or advantages of planning a proper retirement. This gives one individual the stress-free life, tax benefits, cost savings, and also inflation beating returns. Now, what is this stress-free life? See, the most significant outcome of retirement planning is the stress-free life, because financial planning helps us to lead a peaceful and stress-free life. Having an investment rather than the regular income during the retirement gives us the better opportunity to relax and reap the benefits from whatever investment we have made from now itself. The tax benefit under the retirement planning, it also helps us in saving the taxes. For example, the investments if we have made in PPF and national savings certificates, they qualify for tax exemption under the section 80C of Income Tax Act. So that under this, the long-term investments are suitable for retirement, which are exempted for tax concern. Then cost savings. So planning for retirement at the young age will also help us to reduce the cost of our whatever the expenses we are making. For example, if we have purchased an insurance policy, the premium amount what is need to be paid will be lesser when the policy holder is younger. So that is why the best option or the best age to start for the retirement planning is at the young age. Then inflation beating returns. So this is associated with investing in the retirement, which helps in earning the inflation beating returns. That is, holding money in a bank savings account may not generate us the good returns. So in order to get a good return, the proper investment planning will help us to generate high rate of return, so that in future if the value of money is decreased based on the impact of market volatility, such inflation disturbances can be overcome to a greater extent by a pensioner or the retirement beneficiary also. So there are different ways of analyzing what is the need for the retirement. So here we have a structured plan. A person is equipped to handle the various factors as profit, loss, and emergencies in the personal and professional life. So every person needs to understand how quickly or how likely he can achieve his retirement goals. So based on his early earnings monthly salary, and for both the post retirement, every person need to have enough money which is set aside to live the rest of their life maintaining a good lifestyle. So every person needs to plan for retirement because of certain reasons. And these reasons mainly include the factors like first one is to cover the daily living expenses. The daily living expenses for any individual normally they include the necessary living expenses after their retirement. Like uh, every person can has he has to ensure his family the good standard of living. So whatever the day-to-day expenses amount is there, so that can be reached by the retirement benefit. And secondly, being the senior citizens, it is always necessary to have the health expenses. Health expenses will also be there. So to overcome these medical expenses, the mediclaim or health insurance policies, sometimes if they may not cover these medical expenses, definitely the good amount of money saved in the retirement schemes will also help the family and the family members to avoid financial crunch. Then it also helps the person to fight against the inflation. So depending on the volatility of the marketing concept, the variations in the money values, so the people can save today and utilize the same for in the future after their retirement, so that they can maintain at least the same standard of living even after the retirement. Then to deal with the uncertainties. So life is quite unpredictable, and we also say it is uncertain also. Sometimes we may be thrown to adverse situations and circumstances which we may not be expecting. So such emotional difficulties, so this money will help you. Say for example, maybe the influence of natural calamities on our life, or maybe the loss of loved ones, or financial difficulties in the family, or in cases of deceased persons are taking care of them. All such things definitely can be benefited through the retirement amount. And uh, also it is most important to meet our retirement goals. So retirement goals are the objectives that usually one person wishes to achieve in his retirement life. Maybe like some of you may want to be traveling, or some of you may want to explore new places, or taking up new hobbies, or always want to pursue something, maybe studies, whatever it is. Even for such expenses, the retirement plans will help. So there are various steps involved in preparing a retirement plan. So the steps involved in retirement plan, or the process of retirement plan, will have these stages. Usually they go by 6 steps. They include deciding the retirement age. Second one is starting early to retire peacefully. Then determine your retirement purpose, and calculate the future value of your current savings plan, and track and review your plan regularly. So first one, as we have mentioned earlier, the 2020 rule will apply here. So most common retirement age for the individual say is it is 60, and some people may also even wish to retire at the age of 50, 50 plus, whatever it is. So estimating this retirement age is very important, because as we have discussed earlier, before 20 years of retirement, at least we have to decide in advance, so that we can have a handsome money at the time of retirement. So, for instance, if a person is 25 years old now, and he wants to retire at the age of 50, then the years to retirement will be 25 minus 50 minus 25, so that will be is equal to 25 years. So one of the important why we have to decide for retirement at the early age is that if we try to invest at the young stages or earlier stages, you can invest less also, but in future you can get more amount of money. So one of the important factor while deciding the retirement age is the life expectancy rate of individuals. Well, that is the estimated number of years a person is expected to live. And usually this is based on the age, medical condition, family history of individuals, and also the other demographic factors. Okay. Second stage is start early to retire peacefully. See, as we have discussed earlier, if we start investing early in the life, maybe in our 30s or early 40s, so you will get enough time to invest and save your hard earned money. And this will make sure that you will get a good amount of retirement benefit at the time of your retirement, maybe at 55 plus or 60, whatever, that will be benefiting to you. Thirdly, determine your retirement purpose. So here this third stage indicates that you have to decide on the amount you require for the post-retirement stages. That is here this amount of money, what you're going to expect or estimate, it is dependent on the continuation of your same lifestyle, or maybe you want to pursue some other personal goals like traveling, or any other interested area you want to continue. And even it is something continuing with ascertaining your annual expenses at present, and also considering the future expenses depending on the changes in the marketing volatility. So, and it also includes your various expenses like the household expenses, your medical expenses, entertainment, traveling, and even the amount what you're supposed to pay for the EMIs, all these things. So then the factor inflation, calculate how much your present expenses will amount at the time of retirement. This is referred as the future value of money. So this the amount will need every year to meet your post-retirement expenses can be calculated. So calculate the future value of your current savings. So here, how much you are able to save every year after meeting all your expenses plays an important role in building your retirement amount. So your savings is the surplus amount, that is the leftover amount after deducting your annual expenses and from your net salary. So the ideal way is to earmark a portion of your savings towards your retirement. So after estimating how much amount you will be able to save annually towards your retirement amount, the next step is to find what is its future value. So this value of your savings or investment at the time of retirement. Maybe there is decrease in the value of money or increase in the value of money, or maybe you will be having an inflation influence on the money whatever you have sold also. So that states the future value of your money. Then step 5, plan and create an ideal portfolio seeking help and a financial planner. So depending on your current age and the risk that you can afford to take, you should define or you should understand and a standard allocation to each asset. So it is important to have a diversified investment on the portfolios across the classes. That is because some assets like equities will have ability to offer you a better inflation adjusted returns, or it is also known as the real rate of return than the fixed income instruments. And gold can be also a stored value. It acts as the insurance in your portfolio. If you see a swift rally in any of the asset classes and the deviation in your asset allocation, you can timely rebalance and reap the benefits from the respective asset class and moving it to the other asset classes also. Then after this, you have to track and review your plans regularly. Your retirement plans will need to be monitored regularly. At least once in a year, you need to check. This is to ensure that you are on target to meet your objectives. So any changes in your income or in your expenses at the time of retirement will be influenced by such things. So also make sure that your retirement plan meets your investment objectives with the changing marketing scenario. That is very important. So that is why we have to have a check over the plans which we have executed already. Now the next is savings and investment plans for retirement. There are various kinds of investments and savings types. It is discussed in the page number 24 of your study materials. So the savings and investment plans help us to build the retirement amount what we are expecting. So there are various kinds of savings and investment plans which are available, and each one of definitely have their own pros and cons. So it is difficult to discuss each in detail, but we can discuss few plans and have a curriculum of this. So Employee Provident Fund, or we generally call it as EPF, it is a popular savings scheme that has been introduced by the Employees Provident Fund organization under the supervision of the Government of India. So this savings scheme is directed to the salaries class. So facilitate their habit of saving money to build a substantial retirement corpus. The fund is built with the monetary contribution extended by employees and their employer every month. So both the parties, that is the employer and employees, extend 12% each of the employees' monthly salary as their share of contribution towards the employee provident fund. So this fund, which is built, accrues a prefixed rate of interest, and that has been set by the EPFO. The accrued interest from the EPF is tax free, and this can be withdrawn without paying for the same. So employee can avail lump sum amount on their retirement, which is inclusive of accrued interest, and individuals can also apply and avail various online services of EPF of India by accessing the official web port of EPL. And EPF online portal is a user-friendly platform. This ensures the keeping of flow of services transparent, efficient, and hassle-free. So the eligibility to become the EPF members, as we have mentioned, it is for the salaries class. Both the public and private sectors employees can avail this. Additionally, any organization which is employing about minimum of 20 individuals is also liable to extend the benefit of EPF to its employees. So when an employee become an active member of the scheme, they are considered as eligible to avail the several benefits of the EPF funds. So even like insurance benefits and the pension benefit schemes are associated with this. So benefits of EPF India scheme. So this provident scheme extends an array of benefits towards the EPF members. This inculcate a sense of financial stability and security since it is the amount which is saved. So the benefits what we are going to get from EPF is capital appreciation, corpus retirement, emergency corpus, tax saving, and easy premature withdrawal. So these are the different benefits we are going to get. So, capital appreciation is that the PF online schemes offer pre-fixed rate of interest. So, once we start depositing here, we will be getting additional rewards extended at the maturity and ensure the growth in the employees' funds. So, this is appreciation of capital. Then corpus retirement factor. So around 8.33% of an employee's contribution is directed towards the employee pension scheme. So in long run, the sum deposit towards the employee provident fund will help to build a healthy retirement corpus. So such corpus would extend a sense of financial security and independence for the workers after the retirement. Emergency corpus is that so apart from whatever the savings you have made in the EPF fund, it acts as an emergency corpus when individual requires. So some portion of the amount can also be withdrawn in case of emergencies of the fund holders. Then tax savings under Section 80C of Income Tax Act of India, employees' contribution towards their PF account is deemed eligible for the tax exemption. So, moreover, the earnings generated through EPF scheme are exempted from the taxes, and such exemptions can be availed up to a limit of 1.5 lakhs. Then easy premature withdrawal. So members of EPF India are entitled to avail the benefits of partial withdrawal. So in cases if they are in need of money for any type of events like for pursuing the higher education or constructing the houses or bearing the wedding expenses or for the treatment, whatever, in such cases also the employees can take a partial amount. Then rate of interest offered by the EPF. So for the financial year 2020-21, the prefixed rate of interest offered by EPF scheme was 8.55. So this is the amount which is the rate of interest amount compared to the other savings account. It is much more higher. So however, the members are entitled to receive a pension out of their accumulated sum after they turn the age of 58. So let us understand. So we are familiar with the EPF now. Now we have one more thing known as the PPF. It is Public Provident Fund. So this is a popular investment scheme among the investors because of its multiple investor-friendly features. So this is associated with benefits like the long-term investment schemes, which are popular among the individuals who want to earn high but also looking for the stable returns. So safety of principal amount is the prime target of individuals who are opening for the PPF account. So public provident fund scheme is ideal for the individuals with a low risk appetite. So since this plan is mandated by the government, it is backed up with a guaranteed return on project financial needs for masses in India. Further invested funds in the PPF account are not market linked, so investors can undertake the public provident fund regime to diversify their financial investment portfolio. At times of downswinging the business cycle, the PPF accounts can help to preserve the capital of individuals. The features of PPF account. So important features are, first one is investment tenure. PPF account has a lock period of 15 years in investment. So before which the funds cannot be withdrawn completely. So an investor can choose to extend this tenure by 5 years, that is after lock-in period is over. Then about the principal amount, a minimum of rupees 500 and a maximum of 1.5 lakhs can be invested in the PPF fund schemes annually. So here the individual is eligible only for 12 installments in a PPF account in 1 year. Investment in PPF account has to be made every year to ensure the account so that it is active in state. Then loan against the investment. So PPF provides the benefit of availing the loans against the investment amount. However, the loan will only be granted if it is taken any time beginning from the third year till the end of sixth year from the date of activation of this PPF account. So only 25% or less of the total amount is available in the account can be claimed for this purpose, and you have to repay the loan within the 36 months from the date of taking it back. So the eligibility criteria for PPF account is that Indian citizens who are residing in the country are eligible to open a PPF account, and minors are not allowed to open this. And similarly, even the non-residential Indians are not permitted to open PPF account. So, however, there is an existing account in the name of remains till the completion of the tenure. So, these accounts can be extended for another 5 years after the completion of the tenure period. Let us understand the interest on the PPF account. So interest payable on public provident fund scheme is determined by the central government. So it aims to provide higher interest than any type of regularly maintained accounts in the commercial bank. So currently payable such account stands for 7.1%, and this is subject to quarterly updates at the discretion of the government. Now, what are the tax benefits? So, income tax exemptions are applicable on the principal amount invested in the PPF account. So, the entire value of investment can be claimed for tax waiver under the section 80C of income tax of 1961. So, however, it should be kept in mind that the total principal that can be invested in 1 year cannot exceed 1.5 lakhs, and also the tax benefit is available under section 80C. So total interest accrued on PPF investment is also exempt from any type of tax calculations in India. Now the next type is superannuation fund. Now the meaning of the term superannuation is that maybe it is also considered as superannuate. Meaning of this is to become retired or to retire because of the age or infirmity. So superannuation fund or the benefit is a retirement benefit which is offered by an employer to its working class. So superannuation is an organizational pension program, so generally created by the company for the benefit of its employees. So it is also referred as the company's pension plan. So in whichever organization you are working, if your employer decides to give some benefits to the working class, they can opt for this superannuation fund. There are various kinds of superannuation funds, so they can be classified into uh, various criteria based on investment and also benefit offered by them. The first one is based on the benefit plans or defined benefit plans. So, as the name here suggests that it is a benefit plan, so it's a kind of superannuation benefit derived already fixed irrespective of contribution to the plan. So, the predetermined benefit is based on the various factors like number of years of services in organization, then the salary and the age at which the employee starts reaping the benefit. So, this is comparatively a complex and risk generating benefit which is lying mainly on the employer. So upon the retirement, an eligible employee receives a fixed amount which is determined by the pre-existing formula at the regular intervals. Now one more kind is defined contribution plans. So this superannuation benefit is just opposite to the defined benefit plan. In case of defined benefit plan, the benefit is fixed and predetermined, but defined contribution plan has a fixed contribution, and the benefit is directly correlated with whatever the contribution is made, and also the influence of market forces. So this type of benefit is better to manage, and the risk is with the employee. So as he does not know how much he will receive at the time of retirement. So how does this superannuation works? The employer contributes to a superannuation benefit for and on behalf of the employees towards group superannuation policies which are held by him. Organization either manage superannuation funds on their own trust or open a superannuation benefit fund with any approved insurance companies. Like they may try to have the insurance policies from the ICICI endowment plans or new group of superannuation cash accumulation plans, or here based on these plans the employer contributes a fixed percentage of employees basic pay and dearness allowances, and the same percentage of contribution need to be made for a particular category of employees. So, though the contribution is made by the employer, ideally superannuation is a part of cost to company. So, it may also be noted that the employee may also be voluntarily contribute in additional to this amount. And in case of defined contribution plans, at the time of retirement, the employee can withdraw up to 1/3 of the accumulated benefit, convert the balance into a regular pension. So in cases the employee changes his job, he has an option to transfer the superannuation amount to the new employer. And in cases the new employer does not have a superannuation scheme, even they can choose to withdraw their amount or retain this amount fund till the retirement, or withdraw as in the cases if they are in need in the future. Okay. So income tax benefits for the superannuation. So again here also superannuation benefit also provide income tax exemption based on the ATC of Income Tax Act of India. Now the employee contribution to be approved by the superannuation fund is deductible business expenses or any income received by self-managed trust, and approved superannuation fund is also exempt for the employee. So as we have discussed already, so they can invest up to 1.5 lakhs, and 1/3 of the amount can also be exempted from their tax, and they are going to get the tax exemption up to 1.5 lakhs even in the case of superannuation. So the next concept is on gratuity. So this word is derived from the Latin word gratuitas. The meaning of this is gift. So it can be treated as a gift from the employer to his employee for the services what the employee has rendered to the company or the organization by him or her for the development of organization and for the prosperity of the organization. So gratuity is a voluntary payment made by the employers to their employee in return for whatever the services the people or the employees have mentioned. So gratuity is the lump sum amount, so which is paid by the employer to their employees for the services rendered by them. So this is we can consider it as an instrument of social security as well, and also a reward to the person who sacrificed their entire life for the development and betterment of the organization. So the payment of gratuity have been statutory obligation of employer and the right of the employees to claim through the way of enactment of the Payment of Gratuity Act of 1972. So this act provides for a scheme of payment of gratuity to employees engaged in factories, mines, oil fields, plantations, ports, railway companies, shops, or even the establishment for the matter which is connected with the incidental to them. So according to Section 4 of Payment of Gratuity Act of 1972, it is paid on the following occasions. let us understand which are these occasions. One is on the superannuation of the employee, or on his retirement or resignation time, or even on the time of their death or disablement due to accidents or diseases. So, to avail for the benefit of gratuity, the individuals can get this term at the time of their superannuation, at the time of their retirement, or at the time when they are going to resign from the job, or in cases of their in cases of their disability because of any type of disablements, or in cases of their death, that will be for their dependents. So exemptions in respect of gratuity under the section 10 and part 10 of the act here. Retirement gratuity received by the defense personnel under pension code or regulations are applicable to members of the defense services. It is here, it is fully exempted. And any death cum retirement gratuity received by the employees of central government, members of civil services, local authorities, employees are fully exempt from the tax under section 1, 10 and I. So other employees which are covered under the payment of gratuity act is that any death cum retirement gratuity received by the person who is covered under the payment of gratuity act of 1972. So from the tax of at least following extent, that is here rupees 20 lakhs and actual gratuity received, and 15 days of salary based on the last drawn salary for each of the service years. So here the last drawn salary tenure, usually we are going to take for a tenure of working of 26 days. But considering 4 Sundays, 26 working days will be there if there is 30 days for a month. So that is how it is calculated. Now, what is not covered under the gratuity? Any death cum retirement gratuity received by an employee on his retirement becoming incapacitated prior to such retirement or his termination. Then there is again the in cases of his death exempt from the tax to the following extent of the least following. So one is 20 lakhs gratuity actually received and half month salary. So based on the last 10 months average salary immediately preceding the month of retirement of the death of the individuals. So here last drawn salary and the working tenure is for 30 days. So salary for the purpose of calculation of gratuity is not covered under the Payment of Gratuity Act. So this generally includes the basic salary, DA, and provided the terms of employment retirement benefits and forming a part of salaries and common, which is expressed as a fixed percentage of their turnover. So there are certain important points to be considered. Any gratuity received during the period of service is fully taxable. And in case of gratuity received from 2 or more employees in the same or the previous year, then the total amount of gratuity exempt from tax cannot be exceed 20 lakhs. And if the gratuity is received in any earlier or previous year from the former employer, and again received from another employer in the later previous year limit, which is 20 lakhs, will be reduced by the amount exempted earlier. So these things have to be kept in mind. Now, annuity planning. So annuity plan helps us to get a regular payment for the life after making a lump sum investment. Annuity is just the opposite of life insurance. Under life insurance, this generally protects against the financial loss resulting from the premature death. But whereas the annuity gives you systematic returns and provides protection against the economic difficulties. So here it contracts broadly into 4 types. One is on the basis of premium payments. Second one is on the time of payment beginning, and the basis of depositions annuities, and also on the basis of definition of benefits. So on the basis of premium payment, this annuity method is classified into 2 types. One is single premium method and the second one is on installment method. So single premium method is a large amount of money is invested in the annuity plan. So by making one single payment. So as the other term investment installment premium is indicated, here the annuity plans in the certain amount is invested at regular intervals, maybe on the basis of monthly or quarterly or annually that can be paid. So on the basis of time of payment, begin annuity contract, they can be classified into immediate plans and deferred plans. So immediate on annuity plans means there is no accumulation phase and the plan starts working right from the investing phase. So it is purchased with a lump sum and annuity payment starts immediately, either for a limited tenure of lifetime. So deferred annuity plan is that there are the pension plans which annuity starts after a certain date, and it can be further divided into different types like accumulation phase and vesting phase. So accumulation phase is a time when the investor starts investing and accumulating the cash and commences from the date when the first time premium is paid. Vesting phase is that the date from which investor will start getting a policy benefit from the in the form of pension. So the third type is that on the basis of deposition of annuity contracts can be divided into three types like the life annuity, guaranteed premium annuity, and the annuity certain. Life annuity with no refund, it is an here the investor receives a specified amount of income for the life period. So disbursement period varies from 1 year to 50 years. In this method, the family of the investor receives no refund when the investor dies. So guaranteed minimum annuity is that in this type of annuity, the scheme the benefits aren't limited to the investor only, but even this can be extended to his nominees also. In annuity certain, the investor receives a set of amount of monthly income for a specific number of years. So on the basis of definition of benefits annuity schemes, they can be divided into two types. One is on the fixed rate annuity and the second one is variable annuity. So fixed annuity investment, insurance company agrees to pay a guaranteed minimum rate of interest over the investment over the life of the contract. And variable annuity, so here the contract, the amount of return paid to the investor depends on the investment made by the insurance company. So that is the variable concept. Now there are different annuity plans like the life annuity. Life annuity will return purchase price like that, and annuity payable for guaranteed period, inflation indexed, life joint life survivor annuity, joint life annuity, all these things. Let us understand how each one of them will differ. So in the first case, that is the life annuity, usually the individual will get a regular amount uh, payouts from the schemes. That is, till they are alive, they will be getting regular annuity payouts. Maybe regularly for months or quarterly or yearly, but it is stopped after the death of the individual. Then life annuity with return on purchase price. So they will continue receiving the annuity payments regularly till they die. After that, the insurer return the initial amount which was used to purchase the annuity, and that will be given to the nominee of the person. So it's a good option for those who wants to leave the legacy behind them. So annuity payable for a guaranteed period is that here it is to be paid for a guaranteed period, maybe like 5, 10 or 15 years, even if the annuity buyer dies. So annuity stops either on the death of the annual person or on the completion of the guaranteed time period, or whichever is later. So inflation indexed annuity, every year there will be a rise in the annuity payable at a certain rate, maybe like 2% or 5%. It may not be linked to the actual inflation rate, but the rationale is that it would take care of the increase in the expenses of the individuals. So joint life survivor annuity. So this helps in paying till either the person and the spouse they live together, they are alive. And next one is joint life annuity with return of purchase price. This keeps paying even for the individual and their spouse until their life. And in case of death of both, the nominee is going to get the entitlement based on the initial amount invested. So there is one more scheme known as the National Pension Scheme. So this is a social security scheme initiated by the Government of India. Under this pension program, it is open to employees from both public and private sector. Even unorganized sectors, except those from the armed forces, can have the usage of this. Under this scheme, and a national pension scheme account holder will receive the remaining amount as a monthly pension post after the retirement. So here the scheme covered only by the central government employees. Now, however, the Pension Fund Regulatory and Development Authority has made it open to all the citizens of India on a voluntary basis. So anyone who works in a private sector and requires a regular pension after his retirement, they can opt for this. So the scheme is portable across the jobs and locations. So with the tax benefits under the Section 80C of Section 80CCD of Income Tax Act. Now, what are the features and benefits of this national pension scheme? So the first benefit is that it helps in returns and interest. Then the risk assessment, tax efficiency, withdrawal rules, early withdrawals and the exit rules, and equity allocation rules, and option to change the scheme and the fund managers. So these are the benefits received by the National Pension Scheme. Now, the first one is that the portion of pension scheme goes to equities, and however, they offer returns on much higher rate than the traditional tax savings schemes. So this schemes is an effort for over a decade and so far has delivered about 8 to 10% annualized returns. So here you are allowed to change your fund manager if you are not happy with the performance of your funds. A risk assessment is that currently there is a gap of range of 75 to 50% on equity exposure for the NPS. So for government employees, this is 50% to the range of prescribed, and equity portion will be reduced to 2.5%. So each year, beginning from the year in which the investor turns to 50 years of the age, or however the investor of the age of 60 and above. So it is fixed for 50%. So earning potential of national pension scheme is higher as compared to the other income schemes. That is, the rate of return is much more higher. And as far as the tax benefits are considered, again here investing in the NPS, there is a deduction of up to 1.5 lakhs to be claimed for NPS, and for your contribution as well as for the contribution of the employer. Again, Section 80CCD covers the self contribution, and maximum deduction one can claim under 80CCD is 10% of their salary, but not more than the said limits. So that is there. So usually the maximum amount eligible for deduction will be the lowest of the below, like actual NPS contribution by the employer, then 10% of their basics plus DA, or gross total income minus what you can claim, and additional self contribution up to 50,000. So under this section of 80CCD and IB, NPS tax benefits are also there. Now, withdrawal rules. So it is a common brief that you cannot withdraw the entire corpus, but after your retirement, you are compulsorily required to keep aside at least 40% of the amount in this scheme, so that you can receive a regular pension pension uh, from the pension fund regulatory. So early withdrawal and exit rule. So as a pension scheme, it is important for you to continue the investing in the age of 60. So however, if you have been investing for at least 3 years, you may withdraw up to 25% for certain purposes. These include like the occasions of children's marriage, higher education, then building a new house, or even for the medical treatment of self or the family members, all these things. Equity allocation rules. So NPS invest in different schemes, and the scheme E of NPS invest in equity. So you can allocate a maximum of 50% of your investment to the equities. So you can decide on how you are capable of taking the risk to your investment, all these things, or you can split the investment criteria. So there is an option to change the scheme of fund managers. So in case of your investment, you can try to have a contact with your fund managers and have their suggestions to take different types of options available to you while opting for a national pension scheme. So these are all the different types of benefits offered by the national pension scheme. Now we'll move on to the next unit, that is tax planning. So tax planning is a compulsory payment. Here you need to understand the meaning of the term tax and how it is paid. What are the various computations for the individuals, all these things. Tax is a compulsory payment to the government on the income what you are going to earn. So systematic planning for the payment of income tax by using benefits and opportunities provided by the income tax law usually reduce the tax liability. So which also help in making effective financial planning. So tax planning is nothing but evading the tax using the tax law provisions in connection with deductions and investment related activities. So if you are earning some amount of money, so if you are able to invest in various schemes which from which you are liable for the deduction of the taxes, all these things can be understood in this unit. So under the tax planning and personal financial planning, they are interconnected. So the major portion of one's income spent on the form of tax itself, then there is no opportunity to utilize the income for constructive future course of action. So generally, tax planning will provide the benefit of lesser tax liability and make the assessee to enjoy earnings with good savings as well as the investment. So whatever the amount of money we are earning, if everything is deducted in the tax and the tax payment, we may not be able to enjoy whatever the earnings we have made. So for that reason, the tax planning usually provide us the benefit of less tax liabilities. So it is there are various kinds of situations and conditions under which the taxes are exempted, so that whatever the amount of money earned by the individuals can be enjoyed to a greater extent. So having a knowledge of tax payment and computation of the tax help us to enjoy the earning amount whatever we have made in our lifetime. So income tax computation for individuals. So taxable income of an assessee or a person and the tax liability shall be calculated in the following manner. That is, in this slide, you can understand how a person is taxed based on the income earned by them. So firstly, you have to determine the residential status of the individual as per section 6 of the Act. Secondly, calculate the income as per the provisions of respective heads of income. And this section 14 classifies the income under these 5 heads. One is income from the salaries, that is only to be considered for individuals. The income from the house property, in profits and gains from business or profession, then capital gains, and also income from other sources. Thirdly, consider all the deductions and allowances given under the respective heads before arriving at the gross income. So exclude the income exempt under section 10 of the Act. And 5, aggregate the income computed under 5 heads of income after applying clubbing provisions and making adjustments for set of carry forward and losses is known as gross total income. Then the 6th criteria is that deduct the deductions admissible under section 80C and 80U. The balance is called the total income of the individual. So the total income is the round off to the nearest multiple of rupees 10. So that is the income of the person. So here in your materials, also they have given certain tax rates assessment criteria. You have to go through the format to understand how to calculate the tax exemptions. So in your examination, you may not get the computation of tax liabilities, but it helps you people to go for a tax planning actions. So in the page number 41, you can come across the two tables here. The first table is the tax rate for the assessment of year 2021-22. The first table shows it is for the individuals. Then second one is it is from the individuals of age group 60 to 80 whom we consider as senior citizens. And the third table in 42 page number shows the for individuals who are belonging to age group of 80. And this age after the 80s we consider them as the super senior citizens. So there are various exemptions and conditions and criteria we are going to consider for exemption of income tax. Like as per in 2021, so income tax is exempted up to an income of 2,50,000. So that is why here the rate of income after this, here the rate is given nil. So since it is exempted up to 2,50,000, then from 2,50,000 to 5 lakhs it is 5%. Then 5 lakhs to 10 lakhs it is 20%, and balance income and above, that is after the 10 lakhs it is 30%. That is the criteria. And for the senior citizens, it is exempted up to 3 lakhs, and 3 to 5 lakhs it is 5%, 5 to 10 lakhs it is 20%, and balance income above 10 lakhs is 30%. Then for individuals belonging to the age group of 80, that is super senior citizens, up to 5 lakhs of their earnings, income tax is exempted. So that is why here it is nil till 5 lakhs, and the next 5 lakhs to 10 lakhs it is 20%, and the balance income above 10 lakhs is 30%. You can go through this illustration. Based on these three criteria, that is what we discussed for the age group, that is the individuals belonging to less than 60 years of age, then above 60 years of age, and above 80 years of age. You can come across one illustration problem here. The total income of an individual was rupees 12 lakhs. Calculate the tax liability if the assessee belongs to these age groups. That is, one is of age 45, one is of 62, and the one is of 83 years. So in the first table, under the solution, you can come across like this. So this is for the where the assessee belongs to age group of 45. And the income what they have given, it is common for all, it is 12 lakh income. So calculate the tax liability for the SSC. So for this purpose, here you have to answer it like this. So first it is since the 45 years we are taking, it is exempted up to 2.5 lakhs, that is 2,50,000. That is why it is here, it is nil. Then from 5 lakhs to above, that is 5%. So 5 lakhs minus 2.5 lakhs will be 2,50,000. So 5% on 2,50,000 is your 12,500. Then for 10,000 minus 5,000, sorry, 10 lakhs minus 5 lakhs, that will come to again here 5 lakhs. So 20% on 5 lakhs will be 1 lakh. Then above 10, here the amount given is 12 lakhs. So 12 lakhs minus 10 lakhs is 2 lakhs. So you have to calculate 30% on 2 lakhs, that comes around 60. So 60,000. So the total tax liability comes up to 1,72,500. And for this, we have to add a cess of 4%. So that is 6,900. Now add up these two. Your total tax liability will be for 1,79,400. So this is for the age group of 45. Similarly, you can understand for the age group of 62. Similar calculations you have to do. Only here the slabs will be changing. So generally it is depending on the age factor what they have given. In the second table for senior citizens, what they have given, that you have to consider. And here in the third one, where the SSC belongs to the age group of 83, for this you have to consider for the next one you have to consider the third, for the super citizens, super senior citizens, that you have to look for. Now let us understand the next component, that is income tax return or income tax rates in case of companies, trust, and also the other bodies. So this table indicates the rate of income taxes for partnership firms, including the limited liability partnership and the local authorities, and the domestic company, and also for the foreign companies. So the rate of income tax for the partnership, including limited and liability partnership, is of 30%, and for the domestic company, it is the total turnover of the company in the previous years. It was exceeding 400 crores, and then 25% of the total income, or in other cases it is 30% of the total income of the company. So in cases if the company is a foreign company, the 40%, irrespective of the turnover, they have to pay the taxes. So let us understand the different tax rates in case of different organizations. From the examination point of view, you have to know the different criteria. So for the trust, how the tax is exempted, or how to fully exempt the income tax, or what is the way of paying the house or property income, all these things, the criteria you should go through. You have to understand the theoretical aspects over here. So tax rates in case of trust. For application of tax on the trust, the following steps needs to be considered. A trust should be registered, and this registration is under the section 12AA. It provides proceedings relating to registration of the trust. So institutions which are engaged in the charitable activities. Then if it is registered, at least 85% of the donation must be applied on charitable activities, and not on unapplied portion will be taxed at a normal tax slab. Subject to the total donation up to 2,50,000, tax is not payable. Then if not registered under section 12AA, then all the income chargeable as association of person. So in cases if the trust is not registered, then it will be considered as a income chargeable as association of persons, not as the trust. And in cases if it is registered, the trust has to do the charitable activities, which is marking up to a minimum of 85% charitable activities. So in cases of cooperative societies also, the exemptions will be given as it is. So up to 10,000 it is 10%, greater than 10,000 it is 20%, and remaining for all the things it is more 30% taxable is. Now tax rates in case of association of persons or bodies of individuals or other artificial judicial persons, so which doesn't come under the trust, that is what it means. So this is the income threshold up to 2,50,000. Here also the tax rate is not applicable. From 2 lakhs to 50,000, from 2,50,000 to 5 lakhs, 5% income, and in case of income exceeding 2.5 lakhs, so 5 lakhs to 10 lakhs, it is 20%, and over 10 lakhs, it is 30% on income exceeding rupees 10 lakhs. So there are certain note after each of the table. So this helps you people to understand what are the person or who are the individuals who are going to pay the taxes and how the criteria will be. So this note should be understood, or the criteria this is indicated. Surcharge in case of income is more than rupees 50 lakhs and less than 1 crore. So the surcharge is applicable at the rate of 10% of the income tax for income more than 1 crore. So surcharge is 50% is applicable on income tax. Education cess or charge extra 2% on income tax amount plus surcharge, and higher secondary cess is charge extra 1% to the income tax plus surcharge applicable for all the taxpayers. There is also certain amount of exemptions on the house or the property income. So the annual value of a house or the property shall be chargeable to the income tax in the hands of the owner of the house under the head of from the house property. So this is under the section 22 of Income Tax Act. Property, the meaning of the term property is that it is any building or the land which is attached to the building, or land may be in the form of courtyard or compound forming a part of building. So under this case, income of the house or property is calculated based on the annual value of the house. Now the rent received or let out of the building is taxed under the head of the income from the house property. Rent received from open plot of land is taxed under the head of income from house property. Then income from subletting of the house property is taxed under the head of income from business or profession, but not under the head of the income from house property. So there are certain exemptions or complete exemptions for this house property income also. Here, if it is an income from farmhouse, it is exempted from the tax payment, and annual value of one place of ex-Indian rules. Then income from property owned by local authority or scientific research associations, trade unions, charitable trust, political parties, and in case of any other education institutions, hospitals, and even medical institutions, even then it is exempted from tax payment. And income from one self-occupied house, income from property used for assessee, own business or profession, then house for reserved for self-occupation are exempted from the income taxes. Now, annual value under section 23, reasonable value of rent received or receivable from a property is known as the annual value or gross value or gross annual value of this property. So from the gross annual value, allow certain deductions like the municipal tax, then cess, amenities for the house. After allowing certain deductions, the remaining value is called as the net annual value. That is NAV. So computation of net annual value, there is one table which shows the gross annual value. This is the amount here. It will be calculated like this. Kindly understand the format of how these things are made. So to calculate this gross annual value, the first we have to deduct the municipal taxes and municipal cess. So that is shown here. Then under the case of cost of amenities per house, we include all these charges, the water charges, lift maintenance or lighting stairs, then salary of the gardener, gatekeepers, sewage taxes, all these things. Add all these things. Then here you have to less these amount, and whatever the amount is available after deducting all these things. This is known as the net annual value of that particular property. So certain note has to be considered. In cases if municipal tax is paid by the tenant, there is no deduction. In cases if the municipal tax and arrears are due, no deduction is allowed in such cases. There are certain factors need to be considered for calculation of the gross annual value. That is municipal value. It is the value of the property as per the municipality records. Then fair rent, that is the rent which is a rent of the similar property of the locality. Then standard rent is the rent fixed by the rent controller as per the Act of Rent Control, and actual rent is the rent charged for the property during the period of the property which is actually let go generally. Then unrealized rent is that this is the rent which could not be recovered from the tenant. Vacancy is the let out property not occupied for the whole or any part of the previous years. So these things need to be considered to calculate that. And reasonable rent calculations. Reasonable rent calculations will go on like this. When Rent Control Act is not applicable. See, for example, here they have given municipal value property. Here, look out this. Municipal value property or fair rent of the property we have to consider. Whichever is higher will be the gross annual value. So if both are given in case of the problem, the highest value, the whether municipal value is higher or fair rent value is higher, that needs to be considered. When the rent control is applicable, municipal value or fair rent which is higher or then standard rent. So whichever is lower will be your gross annual value. That needs to be taken. The different types of house rent properties. One is let out property. So this property is considered to be the let out when the owner passes the right of its occupancy to usage by another person against consideration. That consideration is nothing but the rent. However, if a person occupies more than one house for residential purposes, then under tax rules, any one of these houses can be considered as the self-occupied. Then self-occupied property, a self-occupied property is the house which is used for one's residential purposes and may be occupied by the taxpayer's family or by their parents, their spouse or children, or a vacant house property is considered as self-occupied for the purpose of income tax. And net annual value of the self-occupied property is usually nil. Now, how to deduct or deductions from the annual value under section 24. So, standard deduction about 30% on net annual value will be there. So, irrespective of the actual expenses incurred, the SSC can be able to deduct a flat rate of 30% on net annual value standard deductions. So, when the annual value of the house is nil, the SSC can't claim the deductions. So, it is not applicable for the self-occupied properties. Interest on borrowed capitals. So, interest payable on loans and borrowed for the purpose of acquisitions, then constructions, repairs or renewals and reconstructions are claimed for deduction. So, here the assessee can claim maximum up to 2 lakh if the loan was taken before the construction, and the deduction for this interest is allowed for 5 equal installments from the year of purchase or construction of the house. So the loan has been taken after 1st April 99 for purchase construction. The assessee can claim the deduction even if he is having a self-occupied property. So there is a format to calculate the income from the house property. So this shows the particulars and the amount how we are going to show this. So to calculate this gross annual value, you have to deduct the municipal taxes and cess. We will arrive at the next annual value, and from that you have to deduct the under section 24 as they have mentioned the standard deduction at 30% and interest borrowed capital at a given rate. So that will give you the income from the house or the property. So for your examination, you have to understand the way how to write these particulars and how to write the amount and how to deduct different options over here. So based on this only, you can calculate. There is an illustration problem. So Miss Kriti owns 4 houses in India which are let out. Compute the gross annual for each house by using the following information. So under this case, there are 4 houses for the person given over here, house 1 to house 4, and the municipal value of each of the houses are like this, and fair rent is like this, standard rent is like this, actual rent is like this. So NA here indicates not applicable. So the solution or how to compute this. So this is the solution for that problem. The particulars are given here and for the 4 houses. So the municipal value and the fair rent they have given. Under this, for all these four houses, we have to consider the highest value. So highest value among these two is the 90 here. And for the second house, it is 60. And for the third house, it is 65. And the fourth one, it is 25. Similarly, in the next column, it is higher 1 and 2, where the standard rent is given. Out of these two, you have considered whichever is lower. So since it is not applicable over here, we have written 90,000 here, then 60, that is the lowest among these two, and 58 lowest among these two, and here 25,000. So here the expected rent is lower of 3 and 4. So the actual rent under these two, you have to consider whichever is higher. So here it is 90, it is 72, it is 60,000 and 30,000. So this is how you are going to calculate the gross annual of 5 and 6. Similar illustration for the next problem won by the Sharon. But here in place of this, they have given only two houses, which municipal tax of 6,000 for one house and interest loan for the house 2, all these things particulars. Only this is given, where they are going to mention house 1 is on let out property and second one is self-occupied property. So here the solution will be like this in a similar manner, but only two comparisons will be given. So in this case, we are going to consider the values like this: 2,80,500. By adding these two, the last two you will get. Okay, now let us understand the statutory provisions pertaining to capital gains. So this is discussed under the section 45 of Income Tax Act. So any profit which arise due to the transfer or sale of capital assets affected in the previous year will be taxed under the head of capital gains. Now capital assets. So to know the capital gains, you should know the meaning of the term capital assets. So capital assets means a property of any kind, whether movable or immovable property, and it can be tangible or intangible assets, like for example land, buildings, furnitures, machineries, gold, jewelries, shares and securities, all these things. So according to section 2 of Income Tax Act, capital gain usually means that it is any kind of property which is held by the assessee, whether not connected with his business or profession. So any securities held by even the foreign institutional investors, and which was invested in securities like those securities which come under the SEBI, that is Securities Exchange Board of India, even they come under this. So now there are capital assets doesn't include certain aspects like stocks in trade, then rural agricultural land, personal effects. Stocks in trade include the raw materials and even the work in progress, materials in stores, and in the form of finished goods, etc. doesn't include in the stocks in trade. And in the agricultural land, as per the definition, only rural agricultural land which are residing in India consider the capital gain exceptions. But in urban agricultural land in India, it is chargeable to tax under capital gains. Personal effects, the assets which are not used by the assessee or by the dependent on the assessee by the family members for the personal purposes. So here these doesn't include the capital assets. But certain movable personal assets, they are going to consider as the capital assets. They exclude certain things. These include the concept, the items like the jewelry, the drawings, paintings, sculptures, archaeological collections, or any other art of work. Such things are not considered as, these are assets, hence considered as capital assets under section 2 under section 2 and branch of 14. So even the gold deposits bonds of 1999 or deposit certificates issued under gold monetization scheme, then specified gold bonds, of 6.5%, 7% on national defense gold, and special bearer bonds of 1991 issued by the central government. So these are excluded. There are certain short term and long term capital assets. So in case of short term capital assets, these are the assets which are held by the assessee for not more than 36 months. So immediately preceding the date of transfer. But any asset or security other than the unit which is listed in recognized stock exchange in India, like UTI units, mutual fund, equity oriented, and zero coupon bonds and all, more than 12 months immediately preceding the date of transfer, it is considered as a short term capital. So since they have given the time period as 36 months. Now the cost computation for this short term capital gains under section 48 is discussed. So this is the format for the capital gain of short term assets. Here we are having particulars and sale or the value is considered. From that we have to deduct the expenses which are incurred. So in connection of the transfers, like this may include any kind of charges of the commission received or the brokerage amount, all these things. By deducting this, you will get the net consideration amount. From the net amount, you have to deduct the cost of acquisition or cost of improvement, and the remaining amount will be your short term capital gain. So cost of acquisition is nothing but the capital asset which were acquired by the seller, and cost of improvement is making any kind of additional alterations to whatever assets we have purchased. So that is however, the assets are considered short term capital if they are not held for not more than 12 months instead of this 36 month mentioned above immediately proceeding the date of transfer, like the listed securities, unit trust of India, and units of mutual funds and zero coupon funds, all these things. So in page number 52, one illustration problem is given, which is just similar to uh, the given criteria here. So here Mr. Jai is salaried employee. In the month of December 2019, he purchased gold worth of 8,40,000 and sold the same in August 2020 for 9 lakhs. So at the time of sale of his gold, he paid a brokerage of 10,000. What is the amount of taxable capital gain? So that is the question. So here you have to put the answer like this in the same format given. So sale or value of consideration is 9 lakhs, that is given in the problem. From this you have to deduct the brokerage amount whatever he has gained. So he has gained brokerage amount of 10,000. So here it is, here he has given brokerage of 10,000. So deduct that from 9 lakhs. So it will be 8,90,000. And from here you have to deduct the cost of acquisition or cost of improvement. So that cost of acquisition is 8,40,000 and cost of improvement is not there. So you have to deduct from the net consideration the amount whatever the cost of acquisition is there. So that will come around 50,000. So this is the short term capital gain of the person Jai by selling his gold. Now computation of long term. So this is the format for computation of long-term capital gain. Here they have given the particulars and the amount here. Under the particulars, we have the sales and value of consideration. Deduct the expenses incurred in connection with the transfer of that. You will get the net consideration. From that, again, cost of acquisition or cost of improvement need to be deducted. And that will, the amount remaining is the long-term capital gain. So less, apart from this, you have to less the exemption as per the section of 54, 54B, 54EC, 54ED, 54F and 54G. In cases, if there is any, that is exemption. Always it may not be there. So deducting from that, you will get your long-term capital gain. So there is in case of if the asset is acquired before April 1st of 2001, cost of acquisition is equal to actual cost or fair market value, or in cases whichever is higher that we have to take. In case of improvement done before 1st April 2001, the cost should be ignored. So cost of inflation rate index, that is given in the page number 54. The central government of India has notified this cost of inflation indexes for different previous years, which are given below. This will be from the year 2001 to 2000. See, this table indicate the cost of inflation indexes. That is how it has been indexed. Cost of inflation index is given for the financial year 2001, 2002 to financial year 2021. So it is from 100 to, the cost of inflation is increased to 301 in 2021. So now from the government gazette, we also have the information that for the financial year 2021-22, it is 317. You can note down that. Then from for another one, that is for the financial year 22 to 23, it is 331. The cost of index, inflation index is that. So here in the page number 56, index cost of acquisition, that formula is given how to calculate the cost of inflation index, that is CII for the year of acquisition. So you can note that here in the particulars in this table how the CII is going to be calculated. So this is how it is. From this problem, Mr. Ram purchased a piece of land in May 2004, rupees 84,000, and sold the same in April 2019, and rupees 10 lakhs 10,000 brokerage. Here the brokerage amount is 10,000. What will be the taxable capital gain in the hands of Mr. Ram? So this is how the particulars have been given the place here. The sales of value of consideration is 10 lakhs 10,000. Now here you have to deduct the expenses incurred in correction. So deduct the brokerage amount. So that will be 10 lakhs. That is the net consideration. Then you have to deduct the index cost of acquisition. So it is noted like 2,14,832, and index cost increment is not there. So the long-term capital gain is 7,85,168. Now in the next page, they have given a formula over here. It is index cost of acquisition minus cost of acquisition multiplied by cost of inflation index for the financial year. So that we have to take from 2019. 1920 it is 281. So that is how you're going to, that is 301, 2021. This is how we are going to calculate the, so capital gain exempt from the tax is that the sale of capital assets lead to capital gains, and these gains should be taxed under the Income Tax Act. So to save the tax on these capital gains, certain exemptions ought to be considered. The first thing is that, so these criteria you have to understand and keep it in mind. So first one, capital gain on sale of residential house under section 54, and capital gain on sale of agricultural land under section 54. These are exempted. And capital gain on compulsory acquisition of land and building under section 54. Capital gain invested in certain bonds under section 54E, exempted of capital gain on investment specified assets for startups under section 54EE, and capital gain invested in residential house under section 54F, capital gain on shift of industrial undertaking from urban area under section 54G, capital gain on shifting of industrial undertakings from urban area to special economic zones under section 54GA, and capital gain on transfer of residential property under section GB. So these are all the criteria for explanation. So here from The page number 56, the explanations for capital gain and the sale of residential house, that for the long term gain and the long transfer of residential property, there are certain conditions, and these conditions include the transfer should be for residential houses, and this must be a long term property. Then the seller should purchase the residential house within a period of 1 year before 2 years after the date of sale of transfer. Construct the new house within a period of 3 years after the date of sale. Deposit with the National Bank under capital gain deposit account. And the new residential house must be in India only. These are the conditions for tax exemption. So, and these things will affect from the financial year 2021 to 2020 to 2021. So the amount of exemption will be allowed under this section lower the value for the following. So second one criteria is that capital gain on sale of agricultural land. In case of any type of long-term capital gain, in case of agricultural land, certain conditions need to be fulfilled. That is, the land must be held at least 2 years before the date of such transfer, and purchase of another agricultural land within a period of 2 years after the date of transfer, and purchase of gain account scheme from the year 1988. Then the third criteria is capital gain on compulsory acquisition of land or building under section 54D. Exemption is given to all the SSC for the industrial undertaking. So there must be compulsory acquisition, property compulsorily acquired, and should not be the land or building forming a part of the industrial undertaking. So asset must have been used in 2 years immediately preceding the date of registration. Within a period of 3 years after the date of compulsory acquisition, any other land or building should be purchased or constructed for the use of industry, and capital gain account scheme of 1988. So there is one more criteria, capital gain invested in the bonds. In such cases, how the exemption is applicable to all the assets. So capital gain which are rising from transfer of any long-term capital asset and the assessee has invested the amount in specified bonds is exempted subject to conditions. And these conditions include transfer the asset should be of long-term asset, and within a period of 6 months of the date of transfer of capital gain must be invested in specified assets. For example, bonds redeemable after 3 years of this National Highway Authorities of India or by the Rural Electrification Limited, like that. Then actual amount invested subject to maximum of 50 lakhs, whether such investment is made on the same financial year or in the next financial year, or partly in the same financial year and the next financial year. There is also exemption on capital gain on investment specified assets like startups under the section of 54EE. It is applicable to all the assessee. The conditions are as follows: like the unit must be issued before 1st April of 2019 and notified by the central government. The amount of such investment made on or before the 1st April 2006 by the SSC during the financial year cannot exceed 50 lakhs, and also the investment made within 6 months from the date of transfer. So exemptions on actual amount of capital investment or maximum limit is of 50 lakhs. So there is one more exemption like capital gain invested in the residential houses under 54 section 54F. The capital gain arising out of transfer of certain capital invested in residential house is exempted from the taxation based on certain conditions. That is, transferred asset should be of long-term asset, capital gain arising other than the residential house, and within a period of 1 year or before 2 years of date of transfer, and assessee should not own more than one residential house from the date of transfer, and also capital gain account scheme of 1988. All these things. And there is one more exemption, capital gain on shifting of industrial undertaking from urban area. So this is specified under Section 54G of Income Tax Act. Exemption is given to all the SSC. Exemption is subject to certain conditions like the plant and machinery, building or land used for the business or industrial undertaking situated in urban area should have been transferred. And the second one is transfer should be made due to shifting of any special economic zone, whether developed in any urban area or any other area, and within a period of 1 year or before the 3 years of date of transfer purchase, machinery, plant or acquired building or land, constructed building or completed shifting to a new area. So here the exemption is actual amount invested in the new asset or the capital gain. We are going to consider both the actual investment in the asset or the capital gains. Whichever is less, based on that amount, the income tax exemptions are allowed. So the deductions allowances. Next concept is on deductions allowances. So after computing all the five heads of income, then the deduction under section 8 is allowable for calculation of total income of the SSC. Following are the different types of deductions what we are going to consider. Under section 80C, investments. So here all the tax paying individuals can claim the tax deduction over this section up to 1.5 lakh annually. So tax deductions are available on various investments and expenses like the life insurance policies, even the provident fund, tuition fees for maximum of 2 children, or principal repayment of home loans, or even the investments in the fixed deposits for a minimum period of 5 years, or in case of investment in the senior citizens having the saving schemes, these taxes are exempted. And in section 80CCC of insurance premium, certain insurance premium like maybe in the annuity plans of LIC or pension fund pertaining to section 1023 AAB, all pensions which are received from such funds are exempted from taxes. And section 80 TTA, interest on savings bank account. So under this, as well as the Hindu undivided family members are eligible for tax deductions under section 80 TTA of maximum of rupees 10,000 pertaining to income from interest from savings account of a bank. So deduction is not valid for the income of interest of fixed deposits, recurring deposits, or the corporate bonds. Then the fourth one is that under section GG, 80GG, payment of house rents. So here the house rent allowances from the employers are the living on rented property subject to 25% of the total adjusted income. So or rupees 5,000 monthly, whichever is less. So then fifth one is a section 80E, here interest paid on education loan. So in cases if the loans are taken for the education, the taxpayer for self or spouse or even for the children, the students with the purpose of pursuing the higher education, deduction is valid for a maximum period of 8 years or till the time when they enter the entire interest is paid or whichever is earlier. Then section 80EE, interest on home loans. Individual taxpayers qualify deductions applicable to interest paid on home loans. Under these cases, taxpayers should have only one house or the property, and the value of property should be less than 50 lakhs, and the loan taken for the property should be less than 35 lakhs. Section 80D for medical insurances. Under this, individuals are eligible for deduction of rupees 25,000 as per section 80D for investment of health insurance of spouse, even the dependent children or for self, and of the age of 60 years, and additional rebate of 25,000 is applicable. And whereas for parents of above 60 years, the applicable deduction is rupees 50,000. In the event of taxpayer, the parent both being above the age of 60,000, then the deduction amount will be of rupees 1 lakh. So in the section 80DD, that is disabled dependent, under this, a certificate of disability from the licensed medical authority is mandatory to claim deduction of this. The rebate is applicable like 75% for disability range of 40 to 80% and 1,25,000 for a severe disability beyond 80%. So here again the kind of disabilities are listed. Maybe like certain common disabilities which are considered for disability deductions are under like this. maybe the leprosy or having blindness, low vision, locomotor disabilities, hearing impaired, and mental retarded. All these things are considered. Then eighth one, section 80DDB, under this, it is called medical expenses. So for the individuals below the age of 60, a tax rebate of rupees 40,000 is applicable under this section for individuals as well as for HUFs. So they can avail for the deduction of any HUF member who is incurred of medical expenses. HUF stands for undivided Hindu undivided family members. So here specific diseases for senior citizens it is up to 1 lakh. Under section 80U physical disabilities. So physical disabilities including the blindness, mental retardedness, all these things. According to this section, about 75,000 and 1 lakh 25,000, which is considered as a more severe disability, will be exempted from the tax. And apart from this, there are certain donations which are exempted from the tax. The tax deductions of 50% and 100% are applicable to donations of various social causes. And these social causes may be included like these criteria, like maybe donating for National Defense Fund, Prime Minister's National Relief Funds, then National Foundations for Communal Harmony, the State Government Fund for Medical Relief or National Illness Assistance, and National Child Care Funds, Swachh Bharat Kosh, Clean Ganga Fund, on all these things, whatever the programs sponsored by the Government of India and the state governments, if it is transferred to that, then there is considered as the donations. And some prominent donations again which qualify for 50% deductions include like Nehru Memorial Fund, Prime Minister's Drought Relief Funds, Indira Gandhi Memorial Trust, and Rajiv Gandhi Foundations. All these things where these things are kept for the social services. A contribution of the employees towards such funds is also exempted from the tax benefit, tax deductions. Then section 80 GGB, here this is for company contributions. So any company which is contributing to a political party or any electoral trust is eligible to this rebate, but cash contributions are strictly not permissible. Now what is allowed is, yeah, types of allowances is that fully taxable allowances include the DA, city compulsory allowances, medical allowances, lunch allowances, overtime allowances, family allowances, deputation allowances, entertainment allowances, all these things. But partly exempted are the house rental allowances, then entertainment allowances, special allowances. Special allowances include all the traveling allowances and daily allowances and even the conveyance allowances. And another type of allowance which is extent of amount received for the limit specified is the children's education allowances, children's hostel allowances, transportation allowances, and the tribal area allowances. So all these are considered for under section 80 GGB of company contributions. And even certain uh, criteria like underground allowances are also given. Underground allowances refers to the employee criteria in cases if the workers are working under the climate underground in the mines, such allowances are exempted from the this, and this will be up to rupees 800 per month. So there are fully tax exempted allowances like allowances to the high court judges or allowances to even more allowances granted to the government employees outside India under section 10.7. All these comes under the tax exemption criteria. So that is with the tax component. Then the next one is the last unit is on health financing. So this chapter gives us a knowledge of different kinds of health related concepts and health insurance concepts which are allowed for the general and the public health concept. So health is being core function of this healthcare system is concerned with mobilization and accumulation and allocation of the money to cover the health needs of the people, so individually as well as collectively. So based on the WHO 2000, it is the purpose of health financing is to make funding available as well as to set the right financial incentives to providers to ensure all the individuals have access to the effective public healthcare system. So that we consider under the universal healthcare coverage or universal health coverage concept. So there are different types of financing models. Mainly there are four types. One is beverage model, Bismarck model, national health insurance model, and out of pocket models. So under the first one, the beverage model, this is a type of single payer national health services, and this was first developed by Sir William Beveridge, so named after him. It was established in the UK and spreading throughout the Northern Europe and the world. So under this, the government act as a centralized establishment of national health services. They try to be the single payers, so eliminating competition among the market. So they try to fund the healthcare throughout the income taxes allows for healthcare to be the free at point of services. So under the central tenet of this kind of system, universal health coverage were guaranteed by the government for every citizen. But common criticism of this system is that there was tendency towards long waiting hours and a guaranteed access to healthcare service and overutilization of system, which was lead to increasing cost for the government. So the next type of system, which is known as the Bismarck model, came to force. Under this, it was a kind of decentralized form of healthcare. This model was created at the end of 19th century by Otto von Bismarck. Employers and employees fund health insurance in this model. So those who are employed have access to the sickness funds created by compulsory payroll deductions. In addition, the private insurance plans cover every employed person regardless of pre-existing conditions. So health providers, generally private institutions and through the social health insurance funds, consider the public. In some countries, there is single insurer, like in case of France and Korea, and in some few countries, it is also like multiple competing insurance. Like non-competing insurance are also there in the Japan, regardless of number of the insurers. So the requirement of employment for health insurance provides benefit and precaution problems. So measures were ensured to employed people will have to take the healthcare needed to continue working and to ensure the productive workforce. So this health concept was considered as one of the right of every citizen. Under the national healthcare insurance model, that is the third model, this here the single payer, that is the national health insurance model, incorporates aspects of both the first and the second models. Under this, the government acts as single player for the medical procedures like Bismarck, but provides all the private. The universal insurance does not make profit or deny claim. Under this, here they in some countries like Canada, private insurance contracting permitted for those who would prefer to them. So the balance between public insurance and private insurance were allowed under this case. Then the fourth one is the out-of-pocket model market, which was driven by healthcare. In less developed areas, the few resources to create mass medical care, patients must be paid for their procedures out of pocket. So without enough money, the poor were unable to offer for proper healthcare systems. That is one thing. Then financing health in India. So the National Health Protection Mission from the Union Cabinet and announced a budget in the year 2018-19, and this tried to provide a coverage of 5 lakhs rupees for every family for about 10.7 crore families belonging to the poor and BPL sections in India. So it comes approximately around 1.3% of the GDP between 2008 to 2015. So from based on the various components and the developments spread across the different concepts of the worldwide, even India started adopting the different healthcare measurements, and these from the Ministry of Health and Family Welfare received an allocation of rupees 54 lakhs and 600 crores. Then based on the Niti Aayog report of 2017, lower income states and a lower revenue capacity, which were spending significant lower on social services on health, further they enhanced this. Then consumer spending level also, out of pocket expenditure dominates these payments. So highest percentage of pocket of health expenses up to 52% that has been increased. So keeping in mind the health concept and the enhancement of the health of the Indian citizens, we have three levels of health concepts which are broadly classified. That is primary care provided by the primary health centers, secondary care is provided by the district hospitals, and tertiary care is provided by the specialized hospitals. Specialized hospitals like AIMS stands for All India Institute of Medical Sciences. Then National Rural Health Mission, it was launched in the April 12th of 2005, and this provide accessible for affordable quality of healthcare, especially for the rural population. And this functions under the NRHM and the Empowered Action Group, and the state as well as even the northern states, eastern and western states of India. All these come under this. So they try to ensure a wide range of determinants of health, like provision for proper water, sanitation, education, nutrition, even social and gender equality concepts. They work on all such things. There are implementation framework for this. The NRHM focuses mainly on reproductive issues, maternal issues, newborn care, then child and adolescent care, all these services. For the implementation purposes, this mission includes making up a public health delivery system for functionally vulnerable communities. Then they have set up certain institutions like at the national level, we have mission steering groups. Then we have health and family welfare groups. We have MSGs, and we have under this health mission. At the state level, these are headed by the chief minister, and the central level it is headed by the Ministry of Family Health and Family Welfare Society. There are certain strategies followed by this. The core strategies include training and enhanced capacity of institutions to control and manage the public health services. Under this, we come under the female health workers like ASHA workers, and health plan for each village, and village health committee for panchayat is given. And there are various kinds of programs offered by these at the multipurpose workers level, the primary health centers level, community health centers level, all these things. Usually they come under provision of 30 to 50 bedded hospitals, and strengthening capacity of the data collection, assessment of the review of evidences, formulation of transport policies, then developing capacities of preventive health measures, all such, even including the healthy lifestyle concept, reduction in consumption of tobacco, alcohol, eradication of those things, all such things are promoted. There are supplementary strategies. Supplementary strategies under this, they include informal rural practitioners to ensure availability of quality resources for the citizens, then revitalizing their local health conditions, providing them the medical care and the medical ethics, then ensuring the poor accessible for affordable and even accountable for the quality of the hospitals nearby. And there are certain institutional mechanisms are set up, like auxiliary nurse midwifery, that is ANM, and as I mentioned earlier, the ASHA, that is stands for Accredited Social Health Activist. All these things. There are various programs offered by both central and state governments, depend to impart the knowledge in the general public relating to health and family health and welfare measurements. So still then there are certain challenges faced by the government of India in the healthcare service and quality. The first is for the lack of infrastructure. Second one is storage of efficient and trained management power, poor health literacy, social stigma, then the privacy issues, health insurance coverage, cost of treatment, distance transportation, and limited appointment availability of officers. Like these include, we lack medical institutes many a time in the rural facilities. Infrastructure is a problem, and we lack trained manpower for medical issues. Poor health literacy among the people of the rural category, and there is less social stigma for many of the privacy connected issues, and the health insurance coverage is not much known to the people, and the cost of treatment is also much expensive compared to different parts of the world. and transportation, rural transportation is much costing higher compared to the urban, and limited appointment availability of the office hours in cases if the medical practitioners are appointed to the rural places, they are not able to stay there, they will come back to the urban places. So in such cases they are not available to the people. So there are various health insurance measures taken up by the different government right, categories. So government health insurance schemes, we have low priced insurance coverage for both urban and rural lifestyles. And usually these things cover that provides for the payment and benefits as a result of sickness or injuries, and it includes the insurance for losses from the accidents, medical expenses, disabilities, accidental deaths, and even for the dismemberance. So there are types of different government health insurance schemes include the Ayushman Bharat Yojana, Pradhan Mantri Suraksha Bima Yojana, Aam Aadmi Bima Yojana, then central government health schemes, employee state insurance schemes, Jan Shri Bima Yojana, universal health insurance schemes, then West Bengal health schemes, Yashaswini health insurance schemes, Mahatma Jyotiba Phule Jan Arogya Yojana, then Mukhyamantri Amritam Yojana, Karunya health schemes, and Telangana state government employees journalist health schemes, and Dr. Y.S.R. Reddy Arogya Siri Healthcare Trust, and many more. So we can discuss one by one here. In the scheme, in the government schemes of this, so Ayushman Bharat Yojana is from the Ministry of Health and Family Welfare. It aims to serve more than 40% of the population of the country. It includes the coverage for medicines, diagnostic expenses, even for medical treatment and pre-hospitalization for the poor families. And Pradhan Mantri Suraksha Bima Yojana, it is from the, even it tries to cover the policy of annual coverage of 2 lakhs for the total disability and a death coverage of 1 lakhs for partial disability. In case of Aam Aadmi Bima Yojana, about one of the, this is one of the newest schemes started in October 2007. So it covers individuals from the age group of 80 to 59 years, and it is for those citizens who are living in both urban and rural areas, and covers even the landless citizens and tenants living in urban and rural areas, including those who are giving scholarships and underprivileged children also. The central government health scheme, this is in the observable in the cities like Kolkata, Mumbai, Lucknow, Delhi, Nagpur, and Pune, and available in all dispensaries relating to services. So here, the X-ray and laboratory examination, all these things will be covered under this scheme. And the most important advantage of this scheme is that it provides free specialist consultation for both hospital and dispensary levels. Then employee state insurance schemes, it is a multidimensional national insurance schemes for the PAC, provide social security for all the employees. So that is one scheme. And Jan Shri Bima Yojana is designed for individuals of poor category within the age group of 18 to 59 years. So under women self-help groups and Shiksha Sahyog Yojana, even they can take the benefit of this. Universal healthcare insurance system is a type of scheme which is implemented to help the families who live below the poverty line. So under this scheme, the once a family member is hospitalized, it facilitates the medical expenses up to 30,000 rupees. However, when the earning head of the family is admitted to the hospital, it provides a compensate of 50,000 rupees daily for a maximum of 15 days. In West Bengal, one more scheme is there, when that is from the government of West Bengal. It in here the family floater on the basis of some insurance 1 lakhs for the OPD treatments, and Yashaswini healthcare insurance. It is from the state of Karnataka. This is useful for peasants, farmers, and all those. And about 800 medical procedures and neurological, orthopedic, and angioplasty. And even this includes the beneficial like cooperative societies. Then every individual belonging to the BPL can avail for Yashaswini. Mahatma Jyotiba Phule scheme. This is followed in Maharashtra, and this is going to be helpful for the families which come under below poverty line. Mukhyamantri Amritam Yojana, it is from the government of Gujarat, and Karunya Healthcare Scheme, it is from the government of Kerala, and this treats with the cancers, kidney cancers, cardiovascular diseases, all these things. And in Telangana state government employees journalist healthcare, They have one beneficiaries for the employed retired pensioner schemes beneficiary available for cashless treatments, and Dr. YSR Reddy Arogya Siri Yojana is there in the Telangana region. So under this scheme, again, this is for the welfare of the poor. They try to even for provide for the people above the poverty line also, and for the working journalist health schemes and employee health schemes provide health coverage to the state government employees. So these generally all the government schemes are aimed at offering the treatment at lower prices, especially for the families of BPL, and ensuring coverage for the entire poor sections of the society, and includes treatment for both the workers of private and government hospitals, and even the employees of the different categories of workforce. So this can be summed up like this. So from the examination point of view, the types of schemes offered by the government insurance schemes you may get for 10 marks, and the challenges faced by the healthcare services in India for 10 marks can be asked like that. So as far as the tax benefits are considered or the tax scheme is considered, kindly note down the different formats and the conditions or the notes, whatever they have given. Concentrate on the theoretical part. Just since it is for 40 marks, I may not get the problems to solve. With this, I will conclude. Thank you.